really kind of help you get your arms around what's happening in real estate nationally and how that's translating into opportunity. So the biggest trend that we have right now is that there's a housing shortage. And let me show you the math on that really quick. Okay. So let me just do this. There we go. So this is a chart, this bottom left chart is one that I've been tracking for since 2015. And it shows the supply and demand element of housing in the US. So you can see here that in the US, we need about 1.7 million new housing units constructed a year. That's a combination of single family, rental, condos, apartments. We need 1.7 million new units built. We need those because we have ones that are burned down, and we have ones that are torn down because they become functionally obsolete. And then we also have an increasing demand because of population growth and immigration. And that demand goes all the way back to about 1980. It's been a pretty consistent level. So since I saw this 11 years ago, I've kind of every year I'm like, okay, that's interesting. Did we build 1.7 million housing units this year? And you can see, like, for a period in the 80s, we overbuilt. But it was really kind of offset by the fact in the early 80s we were underbuilt. And then you can see again, when markets crashed, just like my fellow coaches told me at the high school, we had underbuilt the US market in the early 90s. Starting with 1996 until the crash of 2008, we overbuilt the US market. We overbuilt the US market by about 4 million housing units. In 2008, we were at 2.1 million, on top of 2007, where we were at 2 million, on top of 2006, where we were at 1.9 million. So we had 4 million too many. Money was too cheap. Banks were giving builders more money than they needed. The government was subsidizing mortgages to homeowners. Subprime mortgages were letting people who had no business buying homes get into homes, and that was fueling this like crazy overbuild in the US. What almost crashed the economy is that the smart Wall Street guys started pooling these mortgages into securities and selling them, and they underestimated the default rate. And when we realized in 2008 that we thought the default rate on these mortgages was going to be 2 to 3%, and it was actually going to be 7 or 8%, the value disappeared on those mortgage-backed securities, and it ruined some banks, it ruined a lot of things, and that crashed our housing economy. But when you look at post-crash, and it doesn't matter what metric you look at, we hit an equilibrium of housing. We sold off the excess inventory in 2010, and since 2011, we have never built 1.7 million housing units. Okay, we got back to even in 2011, and we've never built enough houses in the last 13 years. And so now we have this 5 to 6 million unit shortage of housing in the US. So every once in a while I'll see like a Yahoo article that'll say, housing crash. I'm like, crash to what? When you have 4 million too many, yes, you can crash, and an $80,000 house in Speedway can go to 20 grand, and a $200,000 condo in Florida can go to 10,000 when you have too much supply and demand. But when you don't have enough, where does the market crash to? Right? How would the market crash? Now, we're definitely seeing some price softening. Florida is feeling that right now. Okay? Condos in Florida that 3 years ago were worth $500,000-$600,000 are worth $400,000-$500,000. They've softened 8 to 10%. That's just a function of they got too high in 2001, 2002, 2003 when mortgage rates were 3%. Okay? That's not a fundamental problem. Now, there is some fundamental problems with Florida. What are they from? Hurricanes and insurance. We have a very real catastrophe issue in Florida that I think could really hurt that market. Because Florida is so interesting because Florida is the #1 destination for top 1%ers over the last 10 years. You know, you look at like places like Boca, Naples. I mean, Florida is just so sexy for the wealthiest Americans, but they don't care about a $20,000 insurance policy, you know, on a $5 million house. That's nothing. They're not worried about that. It's crushing retirees. And the whole collapsed condo building in Florida has made every other HOA community go back and swing the opposite way of concern. And so you see, I keep reading these horror stories in the Wall Street Journal about, we bought our retirement condo for $400,000. They did an analysis of the structural integrity of our building. We owe $120,000. We can't even sell it for $200,000 now. Oh, and by the way, our insurance has gone skyrocket because of hurricanes. So condos in Florida are horrific right now. So it's really interesting because Florida as a destination is very sexy. Like people they love the climate. We have some clients from Boston, Greg and Brooke. He's an electrician up in Boston. They just spent $1.7 million on this amazing on the water with the dock house down in Florida. And I'm like, why? Like, what are you doing? You know, because I could see a path where but now, what am I looking at with Florida? Well, I'm looking to see if the Republican governor is going to subsidize insurance. Because if that were to happen, there's only one company doing insurance basically in Florida right now. State Farm, all the other companies have pulling out. Here's something else that's interesting because insurance is becoming relevant for real estate in a way that it never has before. Obviously, fires. So anywhere that you've seen fires like California. See, California is a double whammy of earthquakes and fires. Like, does anybody own rental property in California? I just think it's a really tough argument going forward. Why wouldn't you sell it in 1031 into a better market? See, the benefit of being an investor here in the US is you have the luxury of investing in a massive, different state real estate market. You know, if you're in the UK, if you're in Ireland, you have to leave your country, basically the size of Indiana, to invest. You don't have the luxury. We as Americans don't realize we have this luxury that we can live where we want to live and invest in the best place to invest. And when you're looking at rental properties, let me show you the criteria that we use to identify good markets. So this is like the 5-point criteria that I say, if you're going to keep a rental property, you have to have all 5 of these things. And actually, I should add a 6th criteria. Insurance friendly. Because I would not buy a rental property in California because of insurance issues. I would not buy a rental property to hold in any area that has hurricane risk. So all of a sudden, Houston is out, pretty much anywhere Gulf. It's just not, it's not worth it. It becomes such a problem. And because if you're a homeowner at least, like if you live in Florida, you get subsidized insurance, but landlords don't get that at all. And so as an investor, why buy a property in an insurance risk area unless because everything has a caveat, unless you can get it for, 50 cents on the dollar. So, I think of like Manhattan as one of the most landlord unfriendly markets in the country. But if I can buy a 6-unit apartment building in Manhattan for 20 cents on the dollar and make 30% off the rents, I'll happily deal with rent controls, horrible permitting and tax laws. Like, I'll happily deal with it. Does that make sense? And so, of course, I would take a condo in Florida as a rental for $50,000, right? Everything goes out the window. I would love an apartment building on the San Andreas Fault if I can buy it for $80,000 and collect, $10,000 a month in rents. Does that make sense? But when we talk in terms of guidelines, this is how I want you to think of it. Because if you think about it, if you're going to do a flip, like let's say you're going to buy a manufactured home, buy a lot, order a manufactured home, put in a permanent foundation, and flip it. Okay, that's active. That's not passive. That's I'm going to be a developer. So I love doing developments in Florida because I don't care about the insurance. If I buy some land and sell affordable homes, I like flipping mobile homes in Florida. Go into a 55 and older park and buy a trailer for $5,000, fix it up and flip it to the next grandma. Great strategy. So how many of you live in an insurance, tax, or landlord unfriendly market? Who lives in one of those? Okay, so what are the markets then? What are some of those? California, okay. Colorado, definitely. What's that? Yeah, Texas is tough because we started in, hi Laura. We started in Alpine in Texas in 2010. We had an Alpine in Dallas. And we still have stuff in Austin. So Texas is tough because Texas is very, very, they're good with their money. Okay, Texas is business friendly, except for property tax because they charge 3%. Texas has great population growth. Unemployment numbers and job diversification are fantastic. I think there's more Fortune 500 companies in Dallas than there are anywhere in the country, okay? But Texas, that's close to the Gulf with hurricane issues, is bad, and Texas property tax. Now, in Texas, they'll say, well, there's no state income tax, but if I have a rental property that brings in $10,000 a year, and I expense most of that off, and I'm only paying taxes on $6K, and my tax bill for that building is, $9,000, and I'm just not paying personal income tax on $6,000, that's not saving me a ton of money. The property tax bill of $9,000 is annihilating me. So 3% property tax. Texas, no state income tax is only good if you move to Texas. As an out-of-state investor, I have a real problem with that. So Texas has been tough. And rents have not kept up with property values in Texas. 15 years ago, I could buy a middle-class house in Texas for $100,000 and rent it for about $900 a month, so I could make 7%, 6.5%. I could buy a blue-collar house in Garland, Texas for $50,000 and rent it for $800 a month. So I was making 11%, 12% in blue-collar neighborhoods. I could buy a war zone house in Dallas for $40,000 and get $800 a month Section 8. So I was making like 15% in the war zones, right? You can't even get a war zone house in Texas for under $200,000 now. It's like $250,000, and you're only getting like $1,200 a month rent. So if you buy a war zone house in Dallas, usually the idea is that if you buy in a really, really rough neighborhood, you're at least going to make double-digit rents, like Section 8 or something. Dallas now, you can't even make 8% off the worst neighborhoods because rents have not kept up with property values. Does that make sense? Whereas here in Indianapolis, rents have kept up with income and appreciation. It's all been very, very linear. So yes, rents have gone up, so have incomes, so have property values. And so our clients who we were selling properties to in 2009, they were making 7, 8, 9% from the rents. They're making that still. Does that make sense? And so we've stayed here in Indianapolis. We haven't sold a property in Dallas for years because it's, the people who we, imagine the people who we sold a house to in Garland for $90,000 17 years ago that was rented for $800 a month. Now it's bringing in $2,000 a month rent and it's worth $300,000. They're like, I don't want to sell. And I'm like, I understand why. Like, you've done phenomenal, but you got a lot of dead equity in that property. And think of the people who bought those in their IRAs, and now that $2,000 a month is a pension for them. Now, there's volatility. You could have an eviction, you could have repairs, but how many of you need more pension performance in your retirement accounts? Like, who would love to see some of what you have actually be paying you? Okay, that's something that we see very common. So this is how we look at a market. A couple other things that I think are interesting. I look at the state and I look at the city and I see how broke they are. So like Chicago, Illinois is broke. Chicago's broke. They've given too much money in pensions to their employees, city employees. They've borrowed too much money, and so they are always trying to raise tax to offset that. Now, Nicole made a really good point the other day. You can get outside of Chicago, Nicole, and find very landlord-friendly tax rates, can't you? You can get in parts of Illinois. So Chicago is horrible for rentals, but you can do all right in other places in Illinois.
Yeah, for sure. You know what Chicago's trying to do right now? Tax the suburbs. Yeah. Because the suburbs get to enjoy the city.
Right.
And one thing will be that every one of our, any delivery to your house gets a tax and it'll go right to the city of Chicago. Like,
are you serious?
That sounds legal.
Yeah. Because their transportation system is going to shut down if they don't find.
That's interesting.
It's bad. Like, city of Chicago is really bad.
That's really interesting. Here, another example is, what's the Georgia governor's name? Kemp? No. Kemp. Yeah. He was a real estate developer. That guy actually has a really good track record of bipartisan leadership in Georgia. And I heard that he said he's stepping down though, right? Like I heard that he's saying after. But what's interesting is you have Atlanta. Atlanta's horrible with their money. But Georgia, the whole rest of the state is actually great. So I hate Atlanta, I love Georgia. Anywhere in Georgia, any other city with 150,000 people can be great for passive rental. Another example, that would be the opposite, Travis. We love South Carolina, but we hate the state for rentals. South Carolina has a 6% rental tax. 6% they charge on rental income. And so to out-of-state investors. Well, even in-state, right?
In-state does not matter.
Doesn't matter.
And it's 4% if you actually live in the house yourself. In South Carolina, it's expensive.
Is there income? Do they have no income tax also? Or?
Yeah, they have income tax.
Yeah.
They got everything.
No wonder South Carolina is like not talked about.